Hello investors, welcome to Business Learnings. This video is not about any stock, not about any business or industry, but this video will definitely help you generate much better returns in whichever stock you are investing in, whatever kind of portfolio you have. The reason is investing is 90% psychology. It's just 10% the numbers, 10% what stocks you pick. It's 90% your psychology management, and that's why you should be aware of the different biases, the way your brain thinks, so that you can control it to favor the best possible return. In this video, I'll be talking about endowment effect in detail. And so watch the video throughout the end and do subscribe to the channel. Starting with an example in one experiment, the researchers gave each participant a chocolate bar, placing it on their desk, but also telling them that they were not allowed to eat it. For 30 minutes, participants worked on a project with the chocolate bar staring them down all the while. Finally, when the project was done, the researchers told the participants that chocolate bar was theirs. But before they left, people were given choice to keep the chocolate or sell it back at the price they determined. So, on average, participants who sold the chocolate bar sold it for $1.72. However, in another group where the chocolate bar was merely handed over to the people as an award at the end of the project instead of sitting on their desks for half an hour, people only valued the chocolate as $1.35. So this tells that the same chocolate bar is valued differently by different set of people. The first set of people who saw the chocolate bar for entire half an hour while completing their task, they felt that this chocolate bar was given to them as a reward, right? And in those 30 minutes they had developed a sense of ownership, a sense of belongingness for that chocolate, and that's why they valued it at $1.72 on an average. While the people uh, uh, who just received the chocolate bar at the end of their work, right, they didn't have a sense of ownership. They just received it, and they can easily sell it, and that's why they sold it at a much lower price. This tells a very important lesson about the psychology, the human brain, how it functions. It tells us that human brain values more, gives more value to the things that we own. Right? Human brain gives more value to the things that we own. If the same thing is present in the market, we won't value it as much as the thing that we currently own. And I'll give you more examples so that this becomes very clear. The IKEA effect. IKEA sells DIY furnitures. People value their IKEA furnitures more than they value ready-made furnitures, which could be expensive, because while assembling their IKEA furnitures, they had invested their time, their sweat, their effort, their money, and everything. Right? That's why they value their IKEA furnitures more, and that's why this endowment effect, this ownership bias, is also known as the IKEA effect. There is another example, sitting on mediocre stocks that you have been owning for years. Let's say there is a stock that gave you good returns 10 years ago, about 50-60% kind of a return, and you are still holding on to it because it simply looks good in your portfolio. You develop a sense of belongingness, even though the stock is a laggard, the stock is just mediocre, and you can easily replace it with a much better stock. You are still holding on to it. That's another implication of the ownership bias. Another example is investing a significant portion of your money in a company that you have been working for years. Employee stock options you get, right? A lot of people have a decent proportion of their incomes as ESOPs. And this poses a diversification risk. Your company is as likely to go down as any other company, any other listed company, or even unlisted company. Right? There is no sense that you should be investing a significant portion of your money in one single company. It's a concentration risk, it's a diversification risk. If it goes down, most of your money will go down. Right? It's not advisable at all. Similarly, sitting on stocks passed on to you by your parents. There are a lot of people in this world right now whose parents bought Colgate Palmolive stock, for example, Colgate Palmolive, and they are still holding on to it. Colgate Palmolive was a pretty good stock, but the growth is quite limited. The earning visibility is there, but growth is quite limited, and that's why, for aggressive kind of investor, this for younger people, this might not even make sense holding this stock in their portfolio, but people still hold on to it. The reason being, they have developed this sense of ownership. Oh, I have received it from my dad. I should be keeping it active. I should not be selling. So this is the bias that I'm talking about, and that's the reason analysts are aware. The research analysts are aware of this kind of bias, and that's why they give the whole rating. Otherwise, this doesn't mean anything. Either you could have an upside in a stock, that's when you give a buy rating, or you can have a downside in a stock where you will give a sell rating. Right? What's a whole rating? So ownership bias is why analysts have this whole rating. And I'll tell you, most of the app developers, to improve the retention of their apps, they leverage this ownership bias. Most of the salesmen also use this. For example, there will be a lot of apps which will tell you to complete your profile, which will tell you to customize your avatar. For example, Hike was one of the apps. And the more you do these kinds of customizations, the more you feel like home while you visit that app. And that's why you keep on revisiting that app. That's how the developers increase engagement, right? So this is all about the ownership bias, the examples, how it impacts you, and you right now you uh, must have gotten aware of it. Why does it happen? So this happens because of two main reasons. There are several reasons, but so there are two main reasons. When we face a decision, we focus more on what we may lose than what we can gain. So, for example, the Colgate Palmolive example that I just gave, we focus more on what we lose, the high dividends, that dividend cash flows that we keep on getting year on year. We focus that we might lose that, but we are completely ignoring the possibility of a stock which can probably give a 25% kind of a return every single year. We are not seeing that. We are not looking at the opportunity cost at all. We are just looking at what we may lose. Another example is we develop a sense of another reason is we develop a sense of psychological ownership with the product that we have. The app example that I recently talked about, right, in the last slide, when we talked about, you in several apps you customize your avatar, and that's where you start feeling a sense of belongingness to that app, and that's where you start developing this engagement. You keep on coming back and back to the app. There is more of retention involved here. So these are the key reasons, and in the last week slide, we'll talk about how can you, what can you do about it? How can you manage this bias? So first step is taking cognizance of the fact that this exists. Revisit this video whenever making an investment decisions. Revisit this video, read about endowment bias, read about the ownership bias, and then think whether while performing this investment decisions, are you falling prey, are you falling victim to this endowment bias or not, right? Do that. And second thing that you can do is, especially in the investment scenario, ask yourself this question: if you had all cash, so right now you must be having a different portfolio of stocks. Imagine that whatever the value of your portfolio is, you have all of them as a stock. Sorry, you have all of them as hard cash. Which stocks will you buy? Will you will you hold on to that Colgate Palmolive kind of a stock, or will you purchase something else? If the answer is you will not hold on to it, you will not purchase that stock again, then why are you still holding on to it? Sell it and purchase something that you think is a good value for the next decade, right? This example, let me show you this example. Stock A, it gave you a returns of about 25%. Let's say stock B didn't give you any returns. When you are sitting on these kinds of returns, you will see that stock A, oh, nice, 25% returns, and stock B you don't have in the portfolio. If the expected returns for stock A, if let's say the growth and earnings are not, visibility is limited, you are just expecting 5% kind of returns, you will still hold on to it because you'll see that, oh, it looks much greener in my portfolio. 25% is a good return. Even 5 years down the line, it'll still be 35%. Rather, you should be selling it and investing in a stock which has a good potential to see in the next 4 years. Stock A is only giving you 22%, growing at 5%, and stock B, which has a higher growth potential, could give you 84% returns, right? So take cognizance of this endowment effect and then decide your investment decisions. Thanks a lot for watching this video. See you in the next video. Bye.